Next guest says Tesla will need to lower prices even more this year to hit volume targets. Bernstein analyst Toni Sacconaghi joins us now with an underperform rating, $150 price target on Tesla. Tony, why? It doesn't look like they have much of a demand problem here.
Good morning, Sarah. Well, look, I'm not so sure that that demand is really strong. If we look at what happened, they cut prices materially in January up to 20%. And sequential growth was 4%. The last couple of years, it was 1% and 2%. So you took these very large price cuts. Consumers reacted to them, I'm sure, strongly initially. And yet seasonal growth was pretty in line with historical levels. And as we look forward, inventory grew, so they weren't able to sell everything that they made. As Phil mentioned, we're going to have lower incentives or lower credits from IRA, for sure, on the standard range Model 3, potentially on other models. We're waiting to hear exactly what those credits will be. And if we look at lead times for vehicles, other than the Model Y in the U.S., you can get a Tesla within 2 to 4 weeks pretty well anywhere in the world. So there isn't much backlog. As I mentioned, there are about 100,000 cars in the inventory right now. And so it doesn't feel like demand is fantastic right now. And my guess is, as we progress through the year and there's more and more competition, there are 150 new EVs launching in China alone this year, Tesla will likely have to lower prices to make sure it hits its volume targets.
Yeah, your lead time charts in your report today, Tony, are interesting. And you say that you think that the competition has deep pockets and are not going to back off. Some auto analysts argue that it's that conflict between the ICE business and the EV business that's going to create really tough choices for legacy automakers. Why do you think that's not the case?
I don't disagree that there will be tough choices, Carl. I ultimately think at the end of the day, though, companies are being valued on the future, and the future is electric vehicles. And so you've had companies like Ford say, we're going to get to 2 million electric vehicles by 2026. And I think, quite frankly, that's come hell or high water. Yes, they lost $2 billion in electric vehicles this year, but they made more than $10 billion in operating profit in their ICE businesses. So they can continue to subsidize that business. And the market is basically saying, unless you're credible in EVs, we don't want to give you any kind of valuation. And so I think you are going to see leading OEMs like the Volkswagens of the world, like Ford, like GM, who have pretty robust cash flows from their legacy businesses. If they have to take down overall profitability to show that they can be viable in EVs, I think that's the choice they're going to make.
On the other hand, there's a narrative, Tony, that Tesla's leading the pack on the price cuts, and it's hurting the other automakers even worse than it's hurting Tesla, while at the same time they have some pretty ambitious plans to ramp up production in Mexico. They've got the first mover advantage, and the deliveries today show that the price cuts are actually working.
Yeah, I mean, look, I think price cuts in a hyper-competitive industry is generally bad news for everyone. So, last year, Tesla's automotive gross margins were 27%. This year, I think consensus thinks they're going to be 21.5%. And that, and again, we think there could be incremental price cuts. So Tesla is certainly feeling the impact from its own price cuts, and certainly other vendors are. And that's the dynamic that we worry about, is in a really competitive industry where price matters, price cuts are detrimental to total industry profitability. And I think that's what we're starting to see and will continue to see. And that includes Tesla and other incumbents. The good or bad news, I guess, if you're other OEMs, is they're pretty deep-pocketed.
Fair. Tony, thank you. Appreciate your first take on the new Tesla numbers.
Thanks for having me, Sarah.